Most people think investing is about picking the right stocks, but what if I told you the biggest mistake isn't what you invest in? It's where you put your money. There's a strategy financial advisors quietly use that can add hundreds of thousands of dollars to your retirement, and it has nothing to do with beating the market.
All right, today we are opening up the Financial Advisor's Playbook. We're going to go way beyond that basic save for retirement advice and get into the real strategies you need for long-term tax efficiency. This is all about playing the long game and playing it smart.
So let's just dive right in with an idea that might actually surprise you. Most people spend all their energy trying to pick the absolute perfect stock or fund. But the truth, understanding and navigating the tax system is going to have a way bigger impact on your final nest egg. It's the silent force that can either supercharge your money or just quietly sabotage it.
And we're not talking about a small difference here. Over a 30-year career, just using the wrong accounts in the wrong order can easily cost you over $200,000. And that's not from bad investments. That's just money you're losing to taxes you didn't have to pay and all the growth you missed out on because of it. It is a massive, totally invisible cost.
So yeah, this is the big question we're really tackling today. And this isn't some academic exercise, right? The decisions you make, or honestly, the ones you don't make, about which accounts to fund first have very real, very tangible, and very high stakes for your financial future.
To really get this, I want you to picture something simple: buckets. Every single year, the government gives you a set of these special, tax-advantaged buckets you can fill up. But here's the thing. Once December 31st rolls around, that year's bucket is sealed up and it's gone forever. You can't go back and fill it later. So the real cost of not knowing this stuff is leaving these incredibly valuable buckets empty year after year after year.
Okay, so let's start with the most fundamental choice that pretty much everyone faces when they start planning for retirement. This decision, well, it really sets the stage for everything else. The whole debate between a traditional account and a Roth account, it really just boils down to a simple bet. With a traditional account, you get your tax break today. The money goes in pre-tax. With a Roth, you pay the taxes today, and then everything, all the growth, all the withdrawals in retirement, is 100% tax-free. You're basically betting on whether your tax rate is going to be higher now while you're working or later when you're retired. And this quote just nails why that bet feels so impossible. I mean, who knows what the tax laws will look like in 10, 20, or 30 years? Nobody. So a much more practical way to decide is to just look at your tax situation this year. Are you in a really high-income year? That upfront deduction from a traditional account is going to feel really good. Are you in a lower-income year? We'll pay that lower tax now with a Roth and lock in that tax-free growth forever.
All right, now let's talk about the account that I truly believe is the superstar of the tax-advantaged world. It's an account that so many people have access to, but they use it in a completely wrong way. But when you use it correctly, it is, without a doubt, the most powerful tool in your entire toolkit.
Most people see health savings account and their brain just kind of files it away as a debit card for doctor's visits. That is such a massive misunderstanding. The HSA is so much more than a medical spending account. It's a stealth retirement vehicle with advantages you just can't get anywhere else.
This is the magic right here, the triple tax advantage. Number one, your contributions are tax deductible, so it lowers your taxable income this year. Number two, your money grows completely tax-free inside the account. And number three, you can take it out tax-free for qualified medical expenses. I mean, think about that. No other account in the entire U.S. tax code does all three of those things. Not your 401k, not even your Roth IRA. The HSA is in a league of its own.
So the key is to stop thinking of your HSA as a spending account and start treating it like an investment account. First, you max it out. Then you invest the money. And this part is absolutely crucial. You pay for your current medical bills with cash out of your checking account if you can. Then you save every single one of those medical receipts. Why? Because you are building a bank of receipts that lets you pull money out tax-free whenever you want in the future. And here is the final piece of the puzzle that just makes the HSA so incredible. After you turn 65, the account gets this brand new superpower. You can pull money out for any reason at all, not just for medical stuff. If it's not a medical expense, you just pay regular income tax on it, which makes it work exactly like a traditional IRA, but one that has a permanent, tax-free medical benefit attached for life. It's the ultimate financial multi-tool. All right, time for the insider section of the playbook. What happens when you're doing well and your income is too high to contribute to a Roth IRA? The IRS puts up a roadblock, but
The tax code kind of left a back door open. You just have to know where to find it.
So the government sets these pretty strict income limits on who can put money directly into a Roth IRA. Once your income crosses these lines, that option is just off the table. And this is where a lot of high earners just stop, thinking they're locked out of the Roth game. But they're not.
This is the solution. It's called the Backdoor Roth IRA, and it sounds a lot more complicated and sneaky than it really is. It's just a simple two-step process that is totally legal and even acknowledged by the IRS. You make a contribution to a traditional IRA, which, by the way, has no income limits, and then you immediately convert that money into a Roth IRA. That's it. You've just legally sidestepped the income limits.
And for some people, if you have the right kind of 401k plan, there's an even more powerful version of this called the Mega Backdoor Roth. If your employer's plan lets you make after-tax contributions and do what's called an in-service rollover, you can get a ton of extra money into a Roth account, way above the normal limits. Now, this is totally dependent on your specific plan, so you have to check with HR, but it is absolutely worth looking into.
Whew. Okay, we've covered a lot of ground here. How do we pull all of these different strategies together into a simple step-by-step plan that you can actually use? Well, here it is. This is the exact sequence, the hierarchy of where your next dollar of savings should go.
This checklist brings it all home. This is your order of operations. Level 1 is non-negotiable. Get your full 401k match. It is literally free money. Don't leave it on the table. Level 2, max out that triple tax advantage HSA we talked about. Level 3, fill up your Roth IRA bucket using the backdoor method if you have to. And only after you've done all of that do you go back to your 401k at level 4 and contribute until you hit the max. If you follow this order, you will be perfectly optimizing your tax advantages every single year.
So we started with this idea of buckets, right? Buckets that seal shut forever at the end of each year. The past is the past. You can't go back. But this year's buckets, they're wide open, right now, just waiting for you. So the question isn't really if you should start, it's where. Looking at the playbook we just walked through, which empty bucket are you going to fill first?
Here's the uncomfortable truth. You're not just investing, you're making a long-term bet against the future tax system. This is where things flip. It's not about how much you invest, it's about the order you invest in. If you want to keep more of what you earn, not just make more, subscribe. Because the difference between average and wealthy investors isn't just returns, it's strategy. And before this year ends, take a look at your buckets, because once they close, they're gone for good.